Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Nam Phan of Pacific Private Money. Mark Hanf is off today, and Rob Spinoza of Guaranteed Rate. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. And today's trivia theme is random trivia. Now, guys, I want to start off with what seems to be at the forefront of real estate mortgages. This bill that's trying to get passed called AB 2501, and it is, in my opinion, unconscionable. I mean, when you look at what they're trying to pass, and hopefully they won't pass any of it, but basically it sounds like all someone has to do is ask their lender for, if this is units 1 to 4, so most people listening, let's say, are residential, their personal residence. All they have to do is ask for a deferment, and they don't have to prove any hardship. They could be gazillionaires. Bill Gates could do this, right? Ask for a deferment for 6 months, automatically gets granted, and then, oh, by the way, okay, we'll give you another 6 months where you don't have to do anything, right?
Reminds me of that joke. The guy goes to the doctor, couldn't pay his bill, you have 6 months to live, couldn't pay his bill, gave it up.
Yeah, that's right. Exactly. That's right. Exactly it. Yeah. And then after that, you can't charge, the lender can't charge late fees or default interest. And then after that, there's you get into discussions with your borrower to basically say, okay, well, maybe we can modify your loan and reduce the principal and all this stuff. And it's like, wait a minute. I mean, not everybody is getting hit hard by COVID, and why penalize one industry for another? It's not like the innocent lender. And we're not talking about the big banks all the time. It could be the private lender, but then also, and then foreclosures have to stop, until 6 months after we're out of this quote emergency situation. I mean, you know what? I say the politicians. We just decide that they don't get a paycheck anymore. In fact, they have to pay $200,000 a year to be a politician. All in favor? Raise your hand. Right? Yeah, there you go. We knew we'd get a unanimous vote on that. I mean, okay, so that's my little tirade. You guys want to chime in on that?
Yeah, sure. I'll take a stab at it. I mean, I think that the most important thing to remember for all of us, if we are in real estate, and even if we're not, but let's focus on those of us that own property. We are part of a real estate and financial ecosystem. And if you break down part of the ecosystem, there are inevitably, impacts on another part of it. So I thought you touched on the most important thing that I have a problem with, Edward, and that is that there's no need to prove a hardship. I mean, if you are going to simply walk from your commitment or renege on your contract, which is essentially what your mortgage note is, and you don't have a reason to do so, know that you are inflicting harm on some other part of the financial.
Well, and again, it goes, okay, so not only does it hurt existing contracts right now, but think about it. Would Wells Fargo ever make another loan, a real estate loan?
Well,
no.
Well,
right.
Let's look at this in the light of what people are doing. So let's say you live in a community and your children go to public school. Well, if you don't pay your mortgage, okay, let's say your property taxes and your insurance are part of your mortgage payment. You have an impound account.
Oh, good point.
Now, the county is no longer receiving your tax payment, which funds things that affect your community, the community that you live in. So again, we're all tied to this. It's not like you against the banks. It's not like you against the big bad lender.
Yeah. That's a very good point. One other thing I was thinking about this morning was, what about reverse mortgages? You don't have to make payments on those at all. So those lenders who are doing reverse mortgages are unaffected, as well as the borrowers. There's nothing for them to argue with because they're not making payments anyway, right?
Yeah.
So
all of the unintended consequences of legislation like this is it creates a nightmare downstream. So
I think it all has to do with constituents. Again, if they just say, you know what, we're going to pass a law that anybody with green eyes, you're automatically allowed to just knock them off. If they could get elected for doing that, they'd say, sure, that sounds good. Forget the morality. It's just, that's what frustrates me about these stupidity and it's so overreaching,
Yeah.
I mean, at the end of the day, the mortgage bondholders still need to be paid. So they're not exempt from this. And from what I've seen from some of the other legislation, they don't have an out. So in other words, if the payments stop coming in somewhere, somebody still needs to get paid. It's just like, if you lose your job, the bills keep coming. It's not like your bill collects, you lost your job, no problem, don't pay us this month. They have their own bills to pay. And so this is what's happening in the real estate world. These measures, the best of their intent, let's play angel's advocate, right? The best of their intent is you don't want people to foreclose. You don't want to go down that same road again where you start, pulling out the underpinnings of the real estate market and financial and the value of real estate needlessly or carelessly. So but you, Edward, again, you touched on the key issue. You've got to prove a hardship here. I mean, for this to be palatable to me, if you're working and you can pay your bills, if you decide not to do it, there are going to be consequences.
And the IRS gave we have to go to 1 minute break here. We have to. I was going to say the IRS gave a little reprieve of July 15th, rather than April 15th. But they didn't just suddenly say, well, don't worry, you don't have to pay your taxes for 2 years, All right. Boy, that just frustrates me. All right, guys. First commercial break trivia question here is, who was the only president of the Confederate States of America? So you're talking about the Civil War, right? Call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. Who was the only president of the Confederate States of America? And when we come back, we're going to have a little bit more calmer information, because hopefully I will calm down. All right? Stay with us. You're listening to
really read that trivia statement. His hands are shaking so bad.
That's true, exactly. Stay with us. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown here, along with Rob Spinoza and Nam Phan. First trivia question: who was the only president of the Confederate States of America? Who was that?
Well, if he had a statue, it's going to be torn down. I'll tell him that. Jefferson Davis.
Jefferson Davis, that is correct. Okay, now we were talking about this AB 2501 that is trying to get passed, and something that hasn't been talked about yet also is the fact that, let's say you go ahead and you can pay your mortgage payment but you just decide, hey, I can get away with something here by not paying. If I remember correctly, we talked about this a week or two ago, that that's still going to go on your credit report, the fact that you had requested this. And theoretically, lenders are not supposed to take it into consideration, but in the memo, it's going to say you didn't pay your mortgage. Don't you think that's true?
No, we're seeing this already. So initially when it happened, believe it or not, the way these were coded on the credit report, it was saying mortgage affected by natural disaster. So I think before a lot of the language had been figured out, or the way they were going to deal with this had been figured out, they were trying to code it in a way that would tip off creditors, but not exactly accurately. So now you'll see that it says loan is in forbearance. We're getting those on credit reports already. Okay. And when we pull those, what we have to ask the consumer is, where are they in that process? Sometimes they've told us, oh, I haven't even started. I just called the servicer to ask, and they put this flag on there. But others are saying, I've not made payments or whatever.
Wait, so hold on. Just the fact that people just even
adjusting itself to try to figure out.
So you're telling us, excuse me, you're telling us that just the fact that they inquired, ask a question.
That's what they've told us. That's what they've told us. When you get into this stuff, you start to find out maybe it wasn't just an inquiry. Maybe they filled out a form. It's hard to know. There's not uniformity across this in our industry, which is rolled out. So we are starting to see it as my main point, and we have to deal with it head on when we see it.
Wow. So when you're taking in a borrower application and you see this, how much weight does that carry in your underwriting or as a conventional lender? How much weight does that carry?
Well, as they've stated, it's not having an adverse impact on the borrower's score, which is a good thing. But when you see it, you have to ask them the question, because one of the things we've not yet been able to do is close a transaction where they are behind, or not behind, but they have outstanding payments that have not been made. So The guidance is changing. It just recently changed as well. But to the best of my knowledge, it's really difficult to close a transaction where somebody is actively in forbearance and has not brought those payments current. As long as they have, simply having made the forbearance agreement and having upheld the terms of it doesn't appear to be problematic for Fannie Mae and Freddie Mac at this time. But check in with us, periodically, because it is changing. It's in flux. Got
it. So this piece of legislation, Edward, it was barely voted down. I think I don't remember when the last vote was, but I mean, do you know when the next
I think it's coming up pretty soon. They voted it. You're right. It just barely did not pass a few days ago, and then it's coming up again. And you were going to let people know how to vote.
Yeah, I mean, there's right. It does. I mean, the unintended consequences, the domino effect of this, as written, and I'm sure they're making amendments for each, or amending it for each round of voting. But you can go to your congressman, congresswoman, senator to fight this. And many of our listeners, our landlords are own property, and this is going to impact them. And in fact, a lot of our investors are coming to us saying, hey, please make sure that you bring awareness to this to as many of your clients as possible, to your investors.
And I was just hearing earlier this week that someone had told me that a bunch of people in San Francisco just decided to break their lease and just walk. That's it. They just walked. They exited,
Wow.
And I mean, the next thing would be probably car loans, right? I don't have to pay GMAC anymore just because, I mean, if I don't have to pay my mortgage payment, I don't have to pay my car payment,
Yeah.
I'm waiting for PG&E to come out with a grace period of like 3 years, so we don't have to pay.
One thing we've learned through the recent civil unrest and things like that is, society works on a lot of implicit agreements, implicit and explicit agreements, but society, for it to function properly, people have to uphold their commitment, and that means across the board. So if you're gonna stop paying your rent or stop paying your mortgage, it will affect the area in which you live. There is a ripple effect. We're all tied together in some form or fashion, and you can observe this very readily if you live in a condominium project. Wait until 3 or 4 owners, even if the project's 100 units large. Wait till 3 or 4 owners stop making their HOA dues. See the wrench that throws in the works. Even when the HOA has good reserves, now you've got these problem, owners who refuse to contribute, and litigation ensues, and things become really difficult for everybody there. So look, everybody faces hardships at a time in their life. I think that laws made to accommodate those situations comprehensively and in a manner that insulates, that's a good idea. But this wide sweeping stuff, man, I don't see how you implement it without, like what Nam just said, it's just a domino effect, eventually taking down more bids.
Yeah, because didn't they, I don't know if it passed, but they were talking about also just generically in renting, just hey, don't pay your rent, and your landlord can't kick you out. And it's like, really? I mean, I don't understand that. Let's see, guys. We have a quick email here. Comes in for Rob. Says, do conventional lenders offer buy downs of interest rates anymore, and would you recommend it?
Yeah, we see that from time to time. Right now, we're at almost, if not at historic lows. So buying down an interest rate further isn't on a lot of people's minds, but it is possible to do. So what that means is simply, if let's say I'm quoting a borrower a 3% interest rate, and they say to me, well, hey, I really want to get a rate of 2.75. Can I do it? The answer is yes, but what you'll have to do as a borrower is you'll have to sort of pay up front to get that interest rate. And what you're doing, there would be less revenue in that lower rate for the lender. As the rates go lower, there's less revenue on a rate sheet on any given day. But you're making up that deficit by paying points or a fraction of what we call a discount point to get that lower rate. So the equation becomes one of, if you're going to invest, let's say $2,000 into the lower rate, and you're going to save $200 a month by doing so, this is a simple example, it's going to take you 10 months months to recoup that investment. That's the equation you have to do. Will I be in that mortgage in that house in 10 months' time? If the answer is yes, maybe it's worth considering.
Okay.
But again, with low rates, that we're seeing right now, people are generally content to keep their costs low in their process and get the best rate they can without points.
Gotcha. How do people get a hold of you?
They can reach, do a Google search for best mortgage lender ever in the world in history. No, they can. I'm Rob Spinoza with Guaranteed Rate, and they can find me. I'm in Marin County, and so if you go Rob Spinoza or Mortgage Broker Marin County, I'll probably come up. 415-367-5959 is my number.
Very good. All right, guys, cutting to the second commercial break here. The TV show Frasier is based in what city? All right. Email, call 888-912-1190. First caller with correct answers and win that Tanning certificate. Don't touch that dial. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Nam Phan of Pacific Private Money and Rob Spinoza of Guaranteed Rate. Second trivia question. The TV show Frasier is based in what U.S. city?
Is it Boston?
No, that was
No.
Cheers.
Yeah. What was
yeah, all right.
Seattle. It was based in Seattle. And before we get started again, I want to make a mention here for Mountain Mike's Pizza in San Rafael. They are still doing delivery and pickup. You can't eat in the restaurant, obviously, but at least you can. Actually, I guess everyone's going to be starting to open up here pretty soon. So check out Mountain Mike's Pizza in San Rafael. They have very, very, very good pizza. Nam, question comes in for you. It says, why do the distributions in your fund vary from month to month? So you may want to give it
Good
back.
question. So, yeah. So the person who wrote the question is probably referring to the Pacific Private Money Fund. And the Pacific Private Money Fund is a mortgage pool fund or mortgage debt fund. It's made up of loans primarily on residential real estate that our company makes to borrowers who are oftentimes purchasing a home or refinancing. And they come to us when bank financing isn't an option for a number of reasons. It just could be that it's a program that a bank doesn't offer, or it's just a speed issue. They need to buy a property or quickly, and they need to close very fast, and timing-wise, a conventional lender is just not going to make sense for them. And we pool these mortgages in this fund where we're charging borrowers typically rates in the 9s, maybe low 10s. Our investors earn returns north of 7, usually around 7.5%. And the reason why it's usually, which means that the rate of return varies, is because of a number of things. One is the rate that we're charging borrowers. So because we don't charge every borrower the exact same interest rate, that rate's going to fluctuate based on a number of factors like the loan to value, the duration of the loan, the type of loans that they need. And because these rates that we charge borrowers can be different, the rate of return to the investor is therefore different as well. What can also impact that is if we have to take a property back because the borrower is not able to pay, and we have to file a notice of default and foreclose on the property and eventually sell it. If we make a profit, then that profit can be shared in the given month that property is sold. That will boost the yield as well. Likewise, if we had to sell a foreclosed property at a loss, that would affect the yield to the negative. Although in our 13 years of operations, we've never had a loss. And in the fund, we've never had a loss. In the foreclosures that we've had in our company, of which we've probably had about 12, we've never had a loss. So, but again, foreclosing on a property, selling it, those profits are shared with our investors. And in any given month that we would sell a property, that typically would result in a boost in the rate of return for that month. So if you want more information about the Pacific Private Money, if you need to borrow or if you'd like to invest, give us a call, 415-883-2150, or visit us on the web at www.pacificprm.com. pacificprivatemoney.com. We also actually have a fund information session coming up really soon. It's this Tuesday, June 25th. It's going to be at 5 p.m. If you want to register for it, you can go to our website, and it's under the events section. And the website again is www.pacificprivatemoney.com, or call us at 415-883-2150, and Andrea at the front desk will register you. So hope that answers that question. And in fact, you know what? One of the types of loans that we do, I'll mention right now, if you don't mind, I'll just jump into the deal of the week.
Yeah.
So, yeah, here's the deal of the week that, you know, we maybe have mentioned before, but it's worth noting, especially for you contractors, builders out there. We had a loan request come in for $270,000 against a property valued at $900,000.
Wow.
So that's a really low loan to value.
Yeah,
This person, you know, if you went to a bank and they saw that kind of loan to value, they would say, wow, okay, well, you have my attention. This sounds, you know, initially like a deal that we'd want to do. Bank's going to ask you, well, tell me about your business. I'm a contractor. I own, you know, I own multiple properties. Well, how many do you own? You know, I own 7. That's kind of a red flag for the bank, because in this case, the bank that they went to said, you know what, we can't lend you if you own more than 5 properties. And this borrower is going to pull equity out if they needed to you know, as collateral for this purchase. But because they've exceeded a certain number of properties in their portfolio, then the bank's going to typically turn them away.
I'm going to guess if they owned all the properties free and clear, it'd be okay. But Rob, do you see that as a lender that's a problem, because what, a potential domino effect?
Yeah, this becomes a problem if the property they're looking to finance is an investment property. Generally, if it's their primary home, we don't have a limit on how many properties they own.
Yeah, and in this case, it was an investment. Yeah.
The fear is that you know, the stopping of rents coming in from one property, the domino effect, they'll just lose all the property.
Right.
Yeah.
Right.
And that's definitely a real concern, especially right now.
Yeah.
But you know, when you look at the total profile of this borrower and their assets from a private lending standpoint, you know, it's something that we would greenlight, and the exit will be a conventional refinance. I think they were in the process of, or will be selling off some other investment properties so that they can refinance into a conventional loan.
No, it totally makes sense. And the thing is, you're 30% loan to value. So
right.
He'll do everything and anything in his power to make sure he doesn't lose that property.
Yeah, and this is not going to be a 30-year loan to this you know, contractor. It's going to be short-term. They'll refinance once they sell a couple of their other investment properties.
Very good.
But that is a common scenario we're seeing more and more of.
Why don't you give out your information one more time for people to sign up to listen to the webinar coming up?
Yeah. Call us at 415-883-2150, or you can reach us at www.pacificprivatemoney.com. Go to the events section and you can register for our upcoming webinar.
It only costs $500. No, I'm just kidding. It's a free webinar. Okay.
Free. You don't have to pay it if you don't want.
If you don't want, yeah, exactly. Ask for a deferment. Okay, here's our third trivia question. What meal in a box is called the San Francisco treat? You guys remember that commercial, right? Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Don't touch that dial. The best of investing. We are going to be right back. Welcome back to the best of investing. One more time, I'm Edward Brown, your host, along with Nam Phan of Pacific Private Money. Mark Hahn is off today, and Rob Spinoza of Guaranteed Rate. Third trivia question: what meal in a box is called the San Francisco treat?
Rice-A-Roni.
Rice-A-Roni.
All right.
All right, Nam, you want to give us some market outlook, some economic news?
Yeah. So going back to one of our favorite economists, Dr. Christopher Thornberg of Beacon Economics. We talked about him last week. I think he was on a podcast, right, that you listened to,
That's
Edward.
right.
And I love listening to the guy. Generally, he's just straight shooter.
Yeah.
He gives a very you know, objective data, and he doesn't. You know, I love the term miserableism because it's so true with our media sometimes. But he just kind of cuts through all of the drama and kind of gets to the point. And his latest forecast or outlook is for summer 2020, and the headline is "Upbeat Outlook: Economic Recovery from COVID-19 is underway. Ask not if, but how strong the bounce will be." So that's for summer 2020. And he goes on to say, despite the tremendous economic costs of COVID-19 related closures, Beacon Economics' latest forecast for the U.S. and California continues to call for a strong, rapid recovery during the last half of 2020, both for employment and output. And running counter to the vast majority of forecasts, Beacon has been on record predicting a sharp second half recovery for over 2 months. The new outlook, which is again rosier than most, is based on new data that indicates May numbers, once fully available, will be better than April's. And I won't read for too much longer, but it says the pieces of data we see coming in for May suggest that the nation has already passed the low point of economic activity and things are beginning to rebound. If you go to his website too, though, Beacon Economics, it gives graphs of segments of the economy, business segments that may have permanent damage in terms of, you know, the number of years it would take for them to come back, generally being in the hospitality and travel industries and service sectors. But, you know, overall, you know, he's been saying this all along, it's more of a sort of a V-shaped than it is a U-shape in terms of economic recovery. But then again, you know, it will depend on if there's a second wave. But you know, we'll see how when that happens, when that plays out, and when vaccines and more testing come out. But I certainly like this report from him just because, you know, it paints a much more positive picture of maybe what's
You know, I don't know that I agree or disagree with him, but what I will say on this and what I see happening right now is where I think this is going to go, and you know, without getting political about it, but I think where the economy wants to go on this is that we're just going to have to get used to dealing with the virus. I don't see a lot of consumer or financial motivation to do anything other than to try and resume normal activity. The virus began, and I don't know what that looks like from an epidemiological standpoint. I don't know what that is like for our communities and our families, but that certainly seems to be what I see being pushed out from Washington, and I see it echoed in segments of the economy where people are just like, hey, look, it isn't affecting me. I want to get back to work, and I want to do the things I was doing before this whole thing started. So that's kind of the recovery I see on this. Again, I don't know how it ends, but
yeah,
you know, I'd be hard pressed to accept any other predictions on how this thing's going to go other than that, because I don't see the country doing any increased level of testing. You know, it's super comprehensive. So I don't know. I mean, it's going to be very interesting to see how these next 3 to 6 months play out. Like you said, if there's a second wave, if you know the medical conditions become such that it's very difficult to sustain normal activity again, I don't know, but I don't see any appetite to shut down.
I mean, you know, when you talk about the hospitality industry, you know, there's, I mean, Airbnb, you know, VR, you know, I mean, it's Uber. So many people.
Uber and Lyft.
Yeah.
I mean,
ride sharing.
You know, the Hyatt Hotel, you know.
Right.
Wow.
And I think those attitudes from consumers are going to be individual. I don't think policy is going to change that. Like, you could say to me tomorrow, hey, you know, you can go stay at a hotel, but that doesn't mean I'm going to do it.
Yeah.
You know, and depending on where I am along the spectrum of more risk or less risk, you know, I think senior citizens would be crazy to get on a plane. I wouldn't advise my father did that, you know, and so but I think it's being left up to us. It's not being left, it's certainly not being dealt with at the national level. It's being pushed to the state. But at the end of the day, I see it coming back to the consumer, which is where I see the economy going to. What are consumers going to do? And
well, I kind of like the idea of let the consumer decide how much risk he or she will have. You know, again, as long as we're doing certain precautions, you know, the masks and the social distancing, then, you know, I'd rather not have Big Brother telling me exactly what. As long as I'm being known, if I know what the risks are, right?
Well, yeah, I mean, and I think one of the things we do in our daily lives, all of us, is we are experts in our field of profession, and we try our best to kind of express that expertise so that people make smart decisions. Yet, the country, I see a lot of the virus specialists and epidemiologists trying to say the same thing, but yet not everybody's willing to accept that they know better than those people. And I think that's dangerous. But again, here in California, for the most part, I think people have been respectful with the social distancing protocols, wearing masks, and I hope that continues. But that's not the case across the country, and so we'll have to see, because we rely on other parts of the country. It's
true. People come here from over there. But the other part of this, though, is that if the economy takes too big a hit, that's going to have a much more devastating effect on people.
Yeah. The devil you know versus the devil you don't know, right? I mean, it's the devil you know is, hey, if everybody shuts down, we're going to deal with supply chain disruption. We're going to deal with a lot of things that are untenable.
I mean, you'll see alcoholism go up, abuse of children. Yeah. And I mean, there's more divorces that are going on now because I can't stand being in the same house.
One kind of funny story is a report came out. Well, it's not really funny. It's kind of sad, but a report came out that the alcohol consumption increased by 40%. And the stat, how they got the stat was this app that people can download on their phone, a breathalyzer app.
Oh, yeah.
And apparently how they said they got this data is that people are sitting around drinking and out of boredom use the breathalyzer to see what their alcohol consumption was. And the app maker said, people random bored, just sitting there bored, breathing into it. It's shown that 40% of the population has increased, their alcohol consumption. And just think of the people who
once they drive, okay, where am I going to be at the, how much can I drive before getting into trouble or something?
Well, I think they were.
And a real estate centric note on this, one of the things we are seeing, you've probably heard about it yourselves, guys, is that people are looking at their household situation and saying, I got to get out of this.
Yes.
Exactly.
My house is 15,000 square feet and it's too small. There's two of us in this house.
if you needed a backyard in the winter with 3 kids and you didn't have it, you need it now, right? Get me out of here.
I need a doghouse in the backyard.
Oh, that's
because I'm in the doghouse.
I was gonna say we don't own a dog, and I made sure that the doghouse looked really good just for that. All right, guys, we're going to cut to our last commercial break. We already asked our trivia questions. Audience, stay with us. Don't touch that dial. The Best of Investing will be back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Nam Phan and Rob Spinoza. Rob, what kind of activity are you seeing in loan applications since you're a mortgage broker?
I just pulled up a data point. It said California mortgage applications sourced 77% off coronavirus bottom. Applications for purchase money up 7 consecutive weeks. This is dated end of May. So we're seeing a bit of that. I would tell you that if you had asked me a month ago, what are your thoughts on the purchase market? I would have said, well, I'm cautiously optimistic. But the last 3-4 weeks have really proven to me, and we're seeing it in our pipeline, that people who are still employed, knew that they needed to change their living situation, they're taking action, and it's good to see it happening again. I think the spring buying season is pushed back effectively 2-3 months, maybe even a little bit more than that. But most of the real estate agents I talk to are saying they're seeing increased levels of activity, listing interest, buyer interest. Again, a bright spot. I hope it continues. I hope it's not adversely impacted by sort of retracement of the health issues.
Rob, between purchase applications and refinance, how is that balance compared to other time periods? Are you just because there's pent up demand for purchases, just because the market was been on hold, and then interest rates are so low now, people can refi.
Right.
So
Right. So we were almost exclusively refinanced back in March.
Mm-hmm. Now it's more balanced.
It's shifting now. Right, and the shift into purchase as a proportion of new applications is increasing. So I see the purchase market coming back. I feel that energy out there right now, and from when I've talked with other people, real estate agents, they're echoing that as well.
Yeah, I think the lagging part is actual number of new listings coming on, because I think listing inventory is still relatively light. But I think as things continue to open up, you'll see people putting their homes on the market right now, taking advantage of the demand that's out there. What will be interesting, though, I think, is you're seeing rents drop in San Francisco,
Yeah, we've heard about this.
like 10%.
Yep.
How will that translate into home sale, listing prices? Will that, soften, the market for property values? I don't know. That'll be interesting to see over the coming months. But I imagine
I've heard
some people are moving.
stories.
You've heard stories.
Yeah, I've heard some stories about values dropping in the city, but I haven't experienced that myself, and I haven't seen a diminishing of values across the board, not in any appreciable way. Really haven't.
Yeah, interesting.
All right, Rob, why don't you give out your information one more time?
415-367-5959, Rob, with guaranteed rate in San Anselmo.
Okay, and Nam?
All are welcome.
Okay. Nam?
Pacific Private Money, you can call us at 415-883-2150, or you can reach us at online at www.pacificprivatemoney.com.
Okay.
And don't forget about our upcoming webinar. It's June 25th. We're going to talk about some other...
June 23rd.
June 23rd, I'm sorry, I said that in the... June 23rd, this coming Tuesday at 5 p.m., the 23rd of June.
Yeah.
And we're going to talk about other investment opportunities, so you don't want to miss this.
Okay, very good. All right, guys, here's our thoughts for the day. When life gives you lemons, freeze them and throw them as hard as possible at the people making your life difficult. I like that one. And
me too.
My therapist told me the way to achieve true inner peace is to finish what I start. So far, I finished 2 bags of M&Ms and a chocolate cake. I feel better already.
Sweet.
Sweet, yeah, sweet. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.